Ever wonder why a loaf of bread costs more today than it did 20 years ago? It's not because the bread has gotten any better or because wheat is suddenly more expensive. The answer, in a word, is inflation. Inflation, in its simplest form, refers to the general increase in prices and fall in the purchasing value of money over time. It's like a sneaky little thief nibbling away at the value of your money, but how does it work? Why is it considered both a friend and a foe? And most importantly, how can you as an investor benefit from it? To understand inflation, picture an economy as a large-scale barter system. Goods and services are traded every day, and money is the medium of exchange. Now, when there's more money in the system than there are goods and services, prices start to rise. That's inflation in a nutshell. The causes of inflation can vary, but it usually boils down to either demand pull or cost push inflation. Demand pull inflation happens when demand for goods and services outpaces supply. Cost push inflation, on the other hand, is when the costs of production increase, pushing up the prices of goods and services. Now you might ask, why would anyone want inflation? Isn't it just making everything more expensive? Well, yes and no. Inflation can be a sign of a healthy economy. When the economy is growing, people are buying more and businesses are selling more. This increased demand can lead to higher prices, in other words, inflation. So a moderate level of inflation is not only expected, but it's also a good thing. However, too much inflation or hyperinflation can be harmful. It can erode the purchasing power of money, leading to uncertainty and instability. Imagine waking up one day and finding that the price of bread has doubled overnight. Not a pleasant thought, is it? So how can you, as an investor, benefit from inflation? Well, consider investing in assets that are likely to appreciate in value over time, such as real estate or stocks. As prices rise, the value of these assets tends to rise as well, potentially providing a hedge against inflation. In summary, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. It is caused by an imbalance in the supply and demand for money and goods. While a moderate level of inflation signifies a growing economy, hyperinflation can lead to economic instability. However, savvy investors can leverage inflation to their advantage by investing in appreciating assets. So the next time you're at the store and notice that the price of bread has gone up, you'll know why, and hopefully you'll also have an idea of how to make inflation work for you.